The S&P 500 futures and the E-mini futures continue their extend from last Friday. Right now during Asia session at 11 a.m. Singapore time, they are both down by around negative 0.8% due to this ongoing escalation of tension between US and Iran that is still showing no signs of abatement as this war/conflict entered its 31st day. And very interestingly, Yemen militants are now part of this US-Iran conflict, assisting Iran to disrupt further oil flows flowing up from the Red Sea. That actually increases stagflation fear, where oil prices rose above $100 per barrel. And as expected, the West Texas crude oil pierced past our first resistance level, which is at 100.02 handle. And the US dollar continues to hold firm, and due to stagflation risk, gold prices, continues to wobble on the downside. Very good morning to all, and welcome back to another volatile session. I'm Kelvin here, and today will be Monday, the 30th of March, 2026. So before we start our gist of the daily dose, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is for general information purposes and is not investment advice. Past information is not representative of future results. All right, so here we go. So let's kickstart what has taken shape over the weekend and last Friday. Everything is more pertaining to the news flow surrounding from this US-Iran war/conflict. So pretty much new development has taken shape over the weekend over here. So let me share with you what is this new development. All right. Okay, hopefully the screen is good. Correct. Okay, so this new development over here is the Houthis over here. The Houthis, which is the rebel group from Yemen, right now has joined in the Iran conflict, siding the Iranian side of the thing, and that kind of increases stagflation risk. Why do I say that? Give me a minute. Let me share with you this particular chart over here. Okay, so hopefully the screen is good. Okay, let me expand it. So it seems to be a bit slow. You just bear in mind for a couple of seconds. Okay, yeah. Great. So what I could see over here is that even, okay, this is where the rebel group is being based, the Houthis. So right now they are actually assisting Iran. So we know that Iran has virtually shut down the Strait of Hormuz over here by disrupting global oil flows. All right. So in order for the Middle East oil, they got to flow through over here. All right. So to actually elevate this choke point, Saudi Arabia open up another oil pipe, not so open up, increase the oil production pipeline flowing through Yanbu, another hub over here through the Red Sea. All right, so instead of crossing through the Strait of Hormuz, they make a big detour. So this particular oil pipeline increased production by Saudi Arabia is to go through Yebu, Red Sea, and this Bab-e-Mandeb Strait. But with now the Yemen militants, the Houthis, backing up Iran, very likely they will actually disrupt this Red Sea choke point or Red Sea oil supply flow as well. And whatever their ballistic missiles could actually be in shooting range of Yabu, and as well as they could actually send potential sabotage attacks on the Bab of El-Mandeb Strait. So basically, this particular exit point of oil flow will also get potentially choked off as well. So if this point is get choked off by Yemen rebels, that could actually increase stagflation risk tremendously, where oil supply flow will also get disrupted tremendously as well. So that actually explains the current situation right now in the market. Stagflation risk is rising. Current US-Iran war not showing any sign of de-escalation over the weekend, as it's now entered into its 31st day based on today, Monday at 11:07 a.m. Singapore time. That created a risk-off impact into the market because global central bank like the US Federal Reserve hence will be tight to introduce further rate cuts into the US economy due to a stagflation risk scenario. So let me share with you the performance of the market right now. So if you look at the S&P 500 E-mini futures that are trading right now during the Asia session, Singapore time 11:07 a.m. Let me go all the way up over here. So the E-mini futures is down by negative 0.37%. Initially, it was down almost as much as negative 0.7. So right now it's trading at the session high, a bit of bounce. The Nasdaq 100 also managed to stage a slight bounce after a intraday loss of negative 0.8%, now up by negative 0.3% over here. But later I'll share with you the technical chart. This is not a point of a major bullish reversal yet on the Nasdaq 100 and the S&P 500. Despite the fact that the E-mini futures and the Nasdaq 100, the S&P E-mini futures and the Nasdaq 100 E-mini futures are shaping, we call it marginal bounces away from its lowest point at the start of today's Asia session. And one of the reasons why I say that that is not a bullish reversal point yet, because the three major US stock indices, the Russell 2000, the Dow Jones, and the Nasdaq 100 has just entered into a technical correction of minimum of negative 10%. So what do I mean by that? So if you look at the chart of the Nasdaq 100, this is the cash market chart, taking into account of the high that's being seen on 28th of January, almost similar high that was printed on 29th of October. So that's the current all-time high, 26,182 on the Nasdaq 100 cash market. So very clearly, this is a double topper over here. Okay, a double top. And this double top from the right top all the way down to the closing of last Friday is down negative 11.59%, just entering into a technical correction with the breakdown of the 200-day moving average. And if you look at the price chart over here, is a black Marabuzu candlestick. All right. And if you put in the RSI, the weekly RSI, okay, let me delete this. Okay, the weekly RSI hasn't hit the oversold level yet, right? So indicating that despite yesterday's fall and today's E-mini futures rebound, both on the S&P 500 and the Nasdaq 100, double bottom bearish breakdown, breaking below the 200-day moving average, weekly Marabuzu candlestick, weekly RSI hasn't hit the oversold level. This indicates to us that potentially we have not seen a potential major bullish reversal point yet from a medium-term perspective. That means, i.e., we could be still have multi-week of decline taking shape, right, going forward, at least in the near term as well. Very similar on the Dow Jones Industrial Average. The Dow Jones Industrial Average from its current all-time high on 10th of February this year, all the way down to Friday's close, down by negative 10.58%, breaking below the 200-day moving average. Weekly chart, not that bad. It's not showing a bearish Marabuzu candlestick, but if you were to look at a RSI, the weekly RSI, okay, as well, it hasn't hit the oversold level as well. All right, it has some more room to go before the oversold level, indicating that there could be further potential downside on the Dow Jones Industrial Average, indicating that at this juncture, it hasn't reached a medium-term bullish reversal point yet. Next up, the Russell 2000. So the Russell 2000 also hit a technical correction based from its current all-time high on 22nd of January, all the way up to Friday's close, 10%, negative 10%, negative 10.44%. Still at the 200-day moving average, but price action is not showing any signs of bullish reversal as well. If you were to look at the hourly, the weekly RSI, pardon me. Okay, let me remove this. In fact, the weekly RSI has broken below this support level around the 55 level mark and breached below the middle line of 50. Has lots of room to go before hitting the oversold region. So indicating that there is a risk that this 200-day moving average may not hold on the Russell 2000 as well. The only index, major US indices, that hasn't gone into a technical correction will be the S&P 500. From the current all-time high of 28th of January all the way up to Friday's close, negative 9%. But very likely this will follow suit as well with the breakdown of the 20th of August low at 6,343. This is the cash market. Why? Because if you look at the weekly price action, is almost a bearish marabou, not really a bearish marabou candlestick, because we have the shadow at the top, but consider this as a long black candlestick with the weekly RSI. Let me open up the RSI. Still has much more room to go before hitting the oversold region over here. All right, so indicating that this particular juncture on the S&P 500, despite not hitting the technical correction, is also not showing any clear signs of a medium-term bullish reversal. Right, so that I split. And one of the reasons why it's not showing any signs of a medium-term bullish reversal because of a intermarket perspective of rising stagflation risk. So how do I justify that? By looking at this particular chart over here, which is the intermarket correlation. Some of you guys has already seen this chart before, so let me share with you. So this chart is basically using a couple of things to take note of. Let me push it up to here so that you guys could have a better view of the charts. Okay, let me push it back. Okay, so the main driver is the West Texas crude oil. Okay, West Texas crude oil breach, okay, above 100, right, showing no signs of a bearish reversal. And this dotted line here is the Fed long-term inflation target at 2%. All right. Then the next thing I want you to look at over here is this particular blue line and light blue and dark blue line. So the light blue line is the 10-year US break-even inflation derived from the 10-year US Treasury inflation protection bonds. So the 10-year break-even inflation, take it away that is implying what market participants in the US Treasury market, which is the US Treasury protection bonds market, this particular bond is a bit different from your traditional treasury bond because the coupon is dependent on inflation rate. So if inflation rate goes up higher, the coupon rate of this US Treasury protection bonds will go up higher as well. So from there, we are able to infer or imply a forward-looking break-even inflation rate, telling us that from today, based on today's prices of the 10-year US Treasury protection bond, roughly a gauge where will inflation rate in USB 10-year from today. So that's called the 10-year break-even. And the medium-term one is called the 5-year break-even inflation rate. That means, i.e., based on the 5-year US Treasury protection bond, what will be the implied gauge roughly US inflation rate will be 5 years from today. And both of them are now going above the 2% target that the US Federal Reserve desired. All right, so the 5-year is much more sensitive. The 5-year break even right now is at 2.56%, and the 10-year break even continues to trade at the upper limit at 2.31%. And what's interesting is that this elevated 5-year and 10-year break even comes in line with the spike up in the US oil, which is the West Texas crude oil. And that elevated rise previously in May 2022, also caused by exposed COVID period, where we see a pent-up demand due to that previous Biden administration so-called free, we call it fiscal checks that is being printed out by the administration point in time, coupled with also the this food supply squeeze or global food supply crunch caused by various agriculture products supply global supply squeeze due to the Ukraine-Russia war at the point in time, and in some form also impacted energy prices. All right, so that also causes the WTI crude oil to rise as well, in line triggering off a steep push up in the 10-year break-even inflation and the 5-year break-even inflation. And you realize that after the rise of the 10-year and the 5-year break-even inflation, we see the 10-year Treasury nominal yield increasing very steeply as well before hitting a peak in October 2023. So there's actually a lagging element in the 10-year Treasury yield. So if oil prices going to go up very, very significantly, the 10-year and the 10-year break-even and the 5-year break-even inflation rate remains elevated, that could actually see a knock-on ripple effect on a steeper rise going forward in the US 10-year Treasury yield. Right now it's at 4.43% as we are speaking, and this is the highest level since July 2025. So there's a risk that the US 10-year Treasury yield may continue to steep rise higher and higher. All right. So we know that the US 10-year Treasury yield is a global risk-free long-term interest rate, given the fact that the US Treasury market is the most liquid in the world, and given the fact that global, we call it world powers, recognize US as a pretty much default risk sovereign state. So they tend to use the US 10-year Treasury yield as a global risk-free rate to price other credit products. For example, corporate loans, housing loan, and in some form consumer loans, and even some other derivative fixed income product. The risk-free rate is always being used as a benchmark to price the coupon rate. All right. So if this US 10-year Treasury yield keep rising higher and higher, due to its lagging effect, triggered off by a further steepening of the US oil price, which is the West Texas crude oil, that could create an environment where global liquidity is tightening indirectly, even though the Fed is not hiking yet, because the 10-year US Treasury yield is being used as a global long-term risk-free rate to price longer-term loans and longer-term fixed income products. So that could create a liquidity squeeze globally in the system. And if you use the discounting rate to actually discount what you call it net present value of stocks or equity, that will potentially lead to a higher discounting rate. Hence, longer duration equity like technology stocks that tends to invest a lot in their capital investment at the start, where they required longer term cash positive inflow to come in, not coming today, but coming 5 or 10 years from now. So that implies to the hyperscalers in the mega cap technology stocks, which involves AI play, where they invest a lot in data center. So this data center return will not come in the very near term, 1 year from today or 2 years from today. It may come in 5 to 10 years from today. So the longer term of cash inflow that they projected to come in will now has a lower value due to the discounting factor. So because of this long-term interest rate going up, the 10-year US Treasury going up, discounting rate will be higher. Hence, longer duration equity like technology stocks will face the much more significant sell-off. So that is pretty much explained in the performance of those mega cap technology stocks, especially those AI hyperscalers in the S&P 500. So let me share with you the performance. Okay, so this is the S&P 500. Deep sea rate in the mega cap technology stock, Google, Meta, Microsoft, all these are hyperscalers. Nvidia for sure is the guy who provide the tools as well. So if you look at the 1 week performance, okay, so very clearly, all the hyperscalers are deeply in the red. Google, Alphabet, -8%, Meta, -11%, Microsoft, -6%, Amazon, -3%, Nvidia, -3%. All right, over here. So that is the reason why these mega cap technology stocks are facing the brunt right now due to increasing oil prices, leading to a lagging effect on the increase in the longer term US 10-year Treasury yield, therefore increasing the longer term global risk-free rate, which in turn increasing the discounting rate, causing future potential cash inflow on this particular mega cap technology stocks due to their AI heavy capital intensive investment now will be a lower value if we were to discount it back now to the present value. All right, so that actually explains the situation over here. All right, so that is the gist of the daily dose on the first part. So some part over here is that market is currently ignoring this. I think they having a bit of fatigue due to this potential negotiation that Trump's claim that is now taking place over here. So bear in mind that Trump give the Iranians a deadline on by 6th of April to actually open up the Strait of Hormuz over here. So let me share with you. So there's this particular news for stating that Pakistan says that they are ready to facilitate US-Iranian talks within days. All right. So this is something on the headline that is just come out over on today as well, early today's Asia session, but that doesn't really get much fanfare in terms of the price action over here. All right, so now over to the FX market. So over the FX market right now, things are a bit mixed right now. Let me share with you the chart of the performance chart, the 5-day rolling performance chart of the dollar against other major currency. All right, so this is the 5-day rolling performance of the US. Oops, where is it? Okay, let me push it down. Okay, so this is a 5-day rolling. Come on. Okay, so this is the 5-day rolling performance of the US dollar against other major currency, including the Euro Swiss pair over here. So what we could see over here is that the dollar continues to strengthen against the risk off proxy, which is the Aussie dollar over here. All right, so the Aussie dollar now is being viewed as a kind of a risk appetite currency, kind of negating its benefit. It's what I call it benefit, its positive element driven from higher commodities prices. So the Australian dollar sometimes is a chameleon. It tends to weigh between risk appetite and prices of commodity prices. So we know that commodity prices keep going up, it should be beneficial to the Australian economy. But right now, this commodity prices that is going up is not demand-led, it's due to supply we call it a squeeze or the lack of supply from oil prices, creating a stagflationary environment. So stagflationary environment, it means that higher oil, higher cost of doing business, but led to lower demand over here. So that created a what I call it a pull effect on the Australia dollar, where they may not benefit from the higher commodity prices at this juncture, and right now starts to behave moving in line with the global stock market, having more impact on the risk appetite of the stock market or the risk asset. That means due to a demand destruction from this stagflation risk scenario. So that should explain why the Aussie dollar is weak at this juncture, and can't seems to rally in line with higher commodity prices. And also copper prices have started to come down as well because of that stagflation risk creating demand destruction. So that also explains why the Australian dollar can't rally that much. All right, and instead starts to fall in the short term. And because of the fall in the Aussie dollar, that also created a negative feedback loop in the Kiwi dollar as well, where both the dollar is outperforming against the Aussie and the Kiwi versus other major currency. But if you look at the 1-day rolling performance, market participants now are pretty much worried about the dollar yen. All right, so the dollar yen right now is actually the weakest. Later I'll show you why, because the dollar yen has rallied into a major risk intervention zone, where in the past BOJ has intervened 2 years ago to sell dollar, buy back yen. So that just explains why the dollar yen is the weakest currency. The dollar yen is the weakest against the other currencies. That means the dollar is the weakest against the yen right now. So it may create a bit of mixed performance on the intraday basis, creating some form of what I call it K-shaped performance in the FX market in the very near intraday term. And bear in mind, if you were to look at the US dollar index over here, let me show you the US dollar index. So the US dollar index continues to hesitate at this medium-term key range resistance at 110, 154 that has been in place since 28th of May last year, right? As you're going to trade in this complex sideways range configuration, but holding above this 20-day moving average, which is in short term. Okay, acting as a support at 99.50. All right, over here. So given that it's now hitting this key medium-term range resistance of the US dollar index, and with the risk of BOJ intervening in the FX market, there could be a bit of minor setback of dollar strength for some major US dollar pair. So it's a bit of K-shaped performance in the intraday basis for the FX market due to the fear of BOJ intervention, and as well as the dollar index still continues to find a bit of hesitance by the bulls to break above 110/154, which is a key medium-term range resistance of the dollar index, since it has been evolving in a complex sideways range configuration since 28th of May 2025. All right, so that covers the first part of the daily dose. So let me now move on to the second part of the daily dose, which is the intraday technical outlook segment for all the cross asset classes. So let me expand my screen. Okay, good. So I think the screen is good. So let us start with the FX market. Okay, so far good. Okay, let me start with the euro dollar. So euro dollar, last Friday, we do have a pivotal support level looking for a mild rebound as the euro dollar come close to the lower limit of this minor expanding wedge range support level that has been in place since 13th of March. So price actually managed to find support in today's Asia session despite a gap down, and is now covering it. Now managed to cover the gap. Right, yes, we did cover the gap. What we could see over here. So indicating that today's Asia session intraday weakness at the opening has more or less been negated or eradicated. So no change, still using 114.95 as my short-term pivotal support level, since it's the lower managed to bounce off from the lower boundary. So maybe a bit of excess. Let me put the excess, taking into account of today's intraday low during the wee hours of today's Asia session. That is 1488. Okay, 1488. So using 1.1495, 1.1488 short-term pivotal support on the euro dollar, maintain this potential bounce towards the upper limit of this expanding wedge. In first step, going to the middle of the expanding wedge, which confluence with the 20-day moving average at 115.73. Only a bullish breakout above 115.73 may see a potential much more sustainable corrective rebound to retest last Tuesday minor swing high at 116.35. All right. Oops. Let me. Okay. Only a bearish breakdown and an hourly close below 114.95/114.88 that would invalidate today's mean reversion rebound scenario to see a bearish breakdown of the euro dollar to potentially continue its correct bearish impulsive downward sequence, 114.45 followed by 114 figure level in the first step. The next support level to watch. Next will be the sterling pound against the dollar. So the sterling pound broke down below our tightened support level previously at 132.60, and right now it has reintegrated above this support level that we have on last Friday. So very likely it may continue to be trapped in a sideways range, given that the euro dollar and the sterling dollar have a very strong direct correlation, and the euro dollar is now bouncing off from its key short-term pivotal support that we have on last Friday, which is the lower limit of this ongoing expanding wedge configuration since the low of 13th of March. I will flip to a neutrality stance on the sterling dollar for today. So neutral between last Friday US session minor swing high that failed to gain much traction at the 11 p.m. mark Singapore time, 133.13, lower limit 132.20, which is the swing low area of 13th of March. So neutral between 133.13 and 132.20 for now on the sterling dollar. Only a bullish breakout above 133.13 will see a minor mean reversion rebound gaining traction in first step, retesting the 20-day moving average, which is conferencing with the minor swing high of last Thursday, 26th of March at 135.70. Right, so that's for the sterling dollar, flipping to a neutrality stance for today. Next up will be the Aussie dollar. Okay, let me expand the screen of the Aussie dollar. So the Aussie dollar broke below our neutrality zone, lower limit at 68.83 over here. So let me push this up. All right, so this could be the first resistance level to watch, as it's now staged a minor bounce. Okay, after hitting the oversold level. Okay, pivotal support or pivotal resistance will be this upper limit of this minor descending channel that has been in place since 20th of March, and also was the former medium-term pivotal support level, got broken down on last Thursday. All right, over here. So we'll be looking out for any bounce below 69.10, below 69.30. So this will be my short-term pivotal resistance for today to fade the rebound. Given that the RSI is rebounding from the oversold, but it doesn't has a bullish divergence. Okay, there's no bullish divergence coming out, right? So very likely it may just be only a dead cat bounce before another leg of down move materialize for the Aussie dollar. So using any rebound to fade the strength, 69.10, 69.30 short-term pivotal resistance level for today. Bearish bias. Next support level after the breakdown of 68.38 may potentially expose 67.80, 67.66, which is the lower limit of this minor descending channel from the high of 20th of March and the 1.618 Fibo extension of this ongoing corrective decline from 11th of March. And graphically, if you go back over here, is the congestion area of 7th of January and 21st of January this year, right? However, a bullish breakout above 69.30 will invalidate the bearish bias view and see a much more pronounced mean reversion rebound taking hold, exposing the next intermediate resistance level, 69.55, followed by the all-important 70 figure level, which confluence with the 50-day moving average, and as well as this pullback line of this inverse minor head and shoulder formation support broken down turns into a pullback resistance at around the 70 figure level as well. So that's for the Aussie dollar. Next up, the dollar yen. All right, so dollar yen hit 60.23, 160.23, 160.74, and this level here is previously intervention zone where the BOJ step in under the instruction of the Ministry of Finance to sell dollar, buy back yen 2 years ago. So if you look back at the price action chart of dollar yen, this is the daily chart. So this is at that point in time. Okay, on 29th of April 2024, we see a steep sell-off. And over here again on the 11th of July, where this sell-off of the dollar is much more severe, leading to almost a what I call it a 3 month plus of decline, July, or 2 months plus of decline from 10th of July all the way down to the low of 16th of September, right? So roughly 2 months plus of significant decline due to that intervention by BOJ to sell dollar, buy back the yen at a point in time on 11th of July 2024, right? So that's around coming close to 2 years ago. So right now, market participants is a bit jittery of this risk of intervention again. And if you look at from a technical perspective, the hourly RSI has also broken below a key ascending trend line support drawn from its previous oversold level of 20th of March, indicating that there could be further potential downside on the intraday basis on the dollar yen. So using 160.74 as my short-term pivotal resistance level on the dollar yen, Breaking below 15963 may potentially expose the next near-term support level at 15907 in the first step. Breaking below 15907 may expose 158.42, 158 figure level next, which is the swing low area of 24th of March, right? Breaking above and have an hourly breakout and the hourly close above 160.74 may see a further squeeze up towards the longer term pivotal resistance area at 161.70, 161.95, right? So that's for the dollar yen. Flipping to a intraday bearish bias using 160.74 as my short-term pivotal resistance. All right, so that covers all the four major US dollar pair. Let us now proceed with the major stock indices, starting with the Hong Kong 33. So Hong Kong 33 now managed to shape a bounce after coming very close to our support level that we have on a bearish basis on Friday, which is 24,257. So it almost printed a low of 24,321. Okay, very close to 24,257. So right now, bounce is taking shape. So no change, still using the pivotal resistance level because it hasn't broken down below 24,257. I do not want to tighten the pivotal resistance to be so tight at 24,765. So I will use 25,187, 25,380 as my short-term pivotal resistance zone. We also confluence with the 20-day moving average as well. Maintain that bearish bias in any bounces. Breaking below 24,257 may expose the next near-term support level at 23,760, 23,670, which is very close to the lower limit of this ongoing descending channel that has been in place since 29th of January. 0.674 Fibo extension of this ongoing corrective decline from 29th of January 2026 high. And graphically, go back here is the swing low area of 4th of July and 7th of July last year. Okay, only a bullish breakout above 25,380 will invalidate this bearish bias view to see a mean reversion rebound retesting 25,650/25,800, which confluence with the 200-day moving average and the upper limit of the descending channel. Breaking above 25,800 may see a much more deeper mean reversion rebound unfolding to retest the swing high area of 3rd of March, 10th of March, 17th of March, that confluence with the 50-day moving average at 26,224. Right, so that's the Hong Kong 33. Next up will be the Japan 225, that's representing the Nikkei 225. So the Japan 225 also came down, gap down, hit our support zone as expected. So right now it's shaping a rebound, all right, over here. So for this rebound to take shape, we will be fading the strength in this rebound, given the fact that the hourly RSI is not showing any bullish divergence, all right. So use any rebound to fade the strength with a tightened short-term pivotal resistance level for today at 52,380. All right, which is the former minor swing low of last Thursday US session, now turns into a pullback resistance. 52,380 short-term pivotal resistance, tighten adjusted short-term pivotal resistance for the Japan 225 at 52,380, maintaining that bearish bias view. Breaking below 50,160 may expose 48,835. And even 48,250, which confluence with the 200-day moving average, and that is also our long-term pivotal support on the Japan 225, representing Nikkei 225. However, a bullish breakout at the hourly close above 52,380 will see a mean reversion rebound extending further towards the upper limit of this descending channel drawn from the current all-time high of 26th of February. I think as the next intermediate resistance level, they're also coming very close to the downward sloping 20-day moving average at 53,628. So that's for the Japan 225. Next will be the Germany 30. So the Germany 30 also declined lower as expected, almost hit our first support area at 21,930, 21,830. So now it's actually staging a bounce to bounce back up to the former minor swing low of last Tuesday. Now turns into a pullback support at 22,507. So unless we have a clear bearish breakdown during the European session, an hourly close below 21,930, 21,830, then I will tighten the short-term pivotal resistance to 22,507. So for now, pivotal resistance still maintain the same at 23,280, which is the upper limit of this descending channel from the high of 27th of February, and so coming very close to the downward sloping 20-day moving average. Still maintain that bearish bias view. Below 21,830 exposes 21,523 and 21,135, which confluence with the lower limit of this descending channel. However, a squeeze up and a breakout above 23,280 on an hourly basis will invalidate the bearish bias on the Germany 30 to seek out a mean reversion rebound, exposing the next intermediate resistance level at 23,930, 24,300, which is confluencing with the key area of the 200-day moving average and the 20-day moving average as well. The key area of the 200-day moving average, pardon me, and the 50-day moving average. Right, so that's for the Germany 30. Now, key major 3 US stock indices, starting with the US Wall Street 30, that is representing the Dow Jones Industrial Average, plummeted downwards, hitting our first support level for 44,975. 44,810. Okay, so far, no bullish divergence, only an exit from the oversold level. So potentially there could be some form of a bounce taking shape today over here. So this bounce, I will have a tighten short-term pivotal resistance for today at 45,600 level. So using 45,600 level as my tighten short-term pivotal resistance level, only, okay, tighten short-term pivotal resistance level, breaking below 44,810 may expose 44,505 next, which is the 7/13 of August 2025 congestion area. Below it exposes 44,117, 43,905, which is the congestion area of 4th/12 August last year, and also the 0.618 Fibo extension of this ongoing corrective decline currently from the current all-time high of 10th of February. Only a breakout above 45,600 level may see a retest at 45,940. So I'll be watching 45,940 next, because this is the minor swing low previously of 24th of March and 27th of March, a bit of range, that is range bounce scenario that's being formed, and this is the breakdown of the range support. Now turns into a key pullback range, key pullback resistance. Only a clear breakout in the hourly close above 45,940, then that would justify a much more substantial mean reversion rebound to retest the 200-day moving average and the 20-day moving average area at 46,710, 46,970. All right, so that's for the US Wall Street 30, representing the Dow Jones Industrial Average, using a tightened short-term pivotal resistance at 45,600 in the first step to maintain that bearish bias view. Next will be the S&P 500. So the S&P 500 also hit our first support level at 6,360, and right now it managed to stage a bounce back up again. So far, no bullish divergence that's being formed on the hourly RSI, just an exit from the oversold level. So very likely right now there could be a dead cat bounce taking shape. First resistance to watch the dead cat bounce, 6,416, followed by our tightened short-term pivotal resistance at 6,455. All right, 6,416, 6,455. So which is the former minor swing low of 23rd of March, now turns to a pullback resistance. 6,455, tighten short-term pivotal resistance to fade any potential dead cat bounce, maintain that bearish bias. Next support level to watch, 6,290, breaking below 6,290, exposes 6,218, 6,210, which is the 0.681 and 0.236 Fibo extension on the downside. Only a bullish breakout above 6,455 and the hourly close above it will invalidate today's bearish bias view and kickstart a mean reversion rebound scenario, a deeper one towards 6,550 and even the all-important 6,448, which confluence with the 200-day, the 20-day moving average coming very close, the minor swing high of 23rd of March and 25th of March, and as well as the upper limit of this ongoing descending channel since the high of 26th of February. Next will be the Nasdaq 100. So the Nasdaq 100 hit the support level and now staging a bounce as well. So right now, potentially there could be a minor dead cat bounce taking shape over here, given that the hourly RSI had just exited from the oversold level, but no bullish divergence. So first dead cat bounce, resistance zone to watch, 23,400, 23,506, maximum 23,645. If you will do the Fibo retracement of this ongoing minor bearish impulsive downleg after the range resistance that was being seen on 25th of March last Wednesday, all the way to today's Asia session low that confluence with the 50% FIBO retracement. So as long as this dead cat bounce didn't surpass above 23,645, I'll be using this dead cat bounce strength to fade it and maintain that bearish buyer's move on the Nasdaq 100, breaking below 22,970 next, exposes 22,800, 22,680, followed by 22,418 over here, which if we go back in time, is actually the graphical swing low area of 27th of June last year, 1st of July last year, and 2nd of July last year. Okay, only a bullish breakout and the hourly close above 23,645 will invalidate the bearish buyer's view to kickstart a deeper, steeper mean reversion rebound, exposing the next two resistance level at 24,046 before the all important 24,355/24,550, which confluence with the swing high area of 23rd of March that kickstart this current leg of bearish impulsive down move, and also confluence with the 200-day moving average and the 20-day moving average as well at 24,355/24,550. All right, so that's for the Nasdaq 100. Next up, the commodities market, starting with the Gold XAU/USD. So Gold XAU/USD continues to trade in a sideways movement below our pivotal resistance that we have on last Friday. No change. So what it goes do is that as long as 4,620 remains resistance, still maintain that bearish buyer's view. First support level it got to break will be 43.19 level. Breaking below 43.19 level may see a retest on last Monday swing low area at 4,167/4,099. However, a breakout above 4,620 will invalidate today's intraday bearish buyer's view to see a squeeze up to test the medium-term pivotal resistance level at 47.36, 47.75. So that's for Gold XAU/USD using 46.20 as my short-term pivotal resistance level to maintain that bearish buyer's view, with the first support to watch at 43.19. Only breaking below 43.19, the bears may gain more traction to retest last Monday swing low area, and that also confluence with the 200-day moving average at 41.67, 40.99. So that's for Gold XAU/USD. Lastly will be the all-important West Texas crude oil. So West Texas crude oil broke above our first resistance zone at 102 over here, 0.50, right? 102.25. Okay, 102.25. It broke above, and now doing a pullback and managed to find support exactly at 102.25 right now. So potentially, there could be a bit of much more pullback taking shape, given the fact that the RSI is now trying to exit from the overbought level. So lower limit of the pullback zone for today will be this level over here, which is 99.39 over here, 99.39, that I will use last Friday swing low area where it managed to find a bullish, where it managed to print out a bullish hammer candlestick at the 4 a.m. Singapore time on Friday, which is at 93.70. So using a slightly adjusted pivotal support level for today at 93.70, still maintain that bearish. Okay, I repeat again, but times twisting. So using a slightly higher adjusted short-term pivotal support for today, which is very close to last Friday bullish reversal candlestick at 4 a.m. Singapore time on Friday, 27th of March. That will be at 93.70. And also this was managed to find, this was also, come on, let me expand it. Oops. Yeah, good, better. All right, so this was formed at 4 a.m. Friday, Singapore time, and it was also being supported at 10 a.m. on the Friday, Singapore time as well. That is 93.70. So using a slightly adjusted short-term pivotal support, 93.70, maintain a bullish bias on the West Texas oil. Next resistance level to watch, 111.28, followed by the current 4-year high, which was printed on 9th of March, 116.56/119.54. Only a bearish breakdown below 93.70 will negate today's bullish bias to see a retest of the 220-day moving average area, which is the swing low area of 25th of March and 23rd of March at 88.36/85.50. Only a breakdown below 85.50 may trigger off another round of minor corrective decline, exposing 81.85, followed by 77.26, 76.83, which confluence with the rising 50-day moving average. So still maintaining a bullish bias on the West Texas oil, using a slightly adjusted upward short-term pivotal support for today at 93.70. All right, so that sum up the intraday technical outlook, key levels and trend bias on all the major cross asset classes. So before we go, let's have a quick look at the economic calendar. What are the key data to take note of for today? So for today, for the European session, we have Germany flash inflation rate. So market participants will be looking at the harmonized inflation rate, which is the core inflation rate in Germany. So Germany being one of the anchor Eurozone economies, so that could potentially influence the euro dollar as well, and the euro crosses. So that will be at 8 p.m. Singapore time. So 2% for the previous February print. So trading economics is expecting a spike up to 2.6% year on year. So if this come in being expectation or even more than that, the forecast by trading economics, let's say at 2.7 or 2.8, that could actually lend some form of support for the euro dollar. So that will be at 8 p.m. Singapore time. And later on, we have a public speech by Fed Chair Powell, something to take note of as well. So that will be at 10:30 p.m. Singapore time later. That could influence almost all asset classes, right? So that's 10:30 p.m. Singapore time. Potentially, that could influence all the asset classes, given that Fed Chair Powell would still sway the market, even though he will be stepping down soon this coming May, to make way for the new governor, Kelvin. Okay, so that will be at 10:30 p.m. Singapore time. So at 4 a.m. Singapore time, early Tuesday, another Fed official will be speaking, Fed Williams. All right, so that sum up the daily dose of market insights for today. I'm Kelvin here, signing off, and I wish you guys a great day ahead, and we shall speak again tomorrow. Thank you.